Tesla just pulled off something a big chunk of its own owners had quietly written off as impossible. It got its newest self-driving software running on cars built roughly 7 years ago. And the stock noticed in a big way. Tesla finished the day up 9%. We've also got more than 70 Cybercabs spotted in a Dallas lot, Volkswagen walking away from a self-driving partnership and naming Tesla as the reason, a cautious case from a well-known investor, and more. This is the Tesla brief after the close on June 29th. Welcome to the show. A quick look at the stock. Tesla closed up 9% at $411.84. The Nasdaq was up about 2.1%, and the S&P 500 up 1.2%. So the whole market had a strong day, but Tesla ran several times harder than that, and the gap is the tell. This was a Tesla-specific move, driven mostly by the self-driving news we're about to walk through, not just a rising tide. Let's start there because it's the reason the stock moved. Here's the background you need. The brain that drives a Tesla runs on a computer chip built into the car, and there have been a few generations of that chip over the years. The cars built around 7 years ago have an older, weaker version. The newer cars have a much more powerful one. For most of the last 2 years, the working assumption across the shareholder base has been that those older cars were stranded, that they'd never get the big leap in driving quality that the newer cars were enjoying. Tesla even started offering some of those owners a hardware swap to bring them up to date. What changed overnight is that the autonomy team got the newest software called version 14 running on those old chips after all. And the way they did it is the genuinely interesting part. They used a technique called distillation. In plain terms, they took the smarter, newer driving system, the one trained for the powerful chip, and used it as a teacher. Then they trained a smaller, simpler student version to copy how that teacher drives. The student is small enough to fit on the week-old chip, but it has learned to behave like the much bigger system that taught it. To appreciate how hard that is, Elon has said the older computer has only about 15% of the effective working capacity of the newer one. So this is like fitting a far bigger brain into a far smaller skull and having it still think clearly. Ashok Ellaswamy, who runs Tesla's autonomy team, described it simply. They distilled the intelligence from the newer system into the older computer, which lets that older computer learn directly how to handle real driving situations, using the newer system as its guide. The release notes describe better behavior at merges, at traffic lights, around pedestrians, in parking lots, and the ability to start a drive straight from a parked spot. And owners who got it overnight are describing it as feeling like a different car. One reviewer said his 7-year-old Model 3 now drives as smoothly as a brand new one. Now, why does this move the stock 9%? 3 layers. The first is the simplest. The resale value of every one of those older Teslas just went up because they suddenly do something they couldn't do yesterday. The second is about trust. A long-running complaint that Tesla had left its early loyal customers behind just got diffused in a single update. But the third layer is the one that matters most for the long-term story, and it's the one I'd hold on to. Tesla just demonstrated that it can take its very best, newest driving model and compress it down to run on far weaker, cheaper hardware. That is exactly the muscle Tesla needs as it scales toward the Cybercab and a worldwide self-driving rollout. Because cheaper hardware that still drives well is what makes the economics of a giant robotaxi fleet work. So this wasn't just a nice gift to old owners. It was a live proof of a capability the whole autonomy thesis depends on. That feeds straight into the next story, because the Cybercab itself moved closer today on 2 separate fronts. First, the Texas Department of Public Safety added the Cybercab to its official page called the Connected Autonomous Vehicles First Responder Interaction Plans. That's the document police, fire, and paramedics use to know how to handle one of these vehicles at the scene of an accident. A car doesn't get added to that page until the state expects it on public roads soon. So this is regulatory plumbing, and it's now visibly in motion. Second, drone footage circulating today shows more than 70 Cybercabs parked in an outbound lot near Dallas. That's a sharp jump from the counts we've been tracking over the past couple of weeks, which tells us production at Giga Texas is clearly continuing. Put those together, and the picture is a real commercial robotaxi service built around the purpose-made Cybercab, not the Model Y filling in, getting genuinely close. And there's a date attached. Tesla has teased an announcement for next Tuesday, July 7th, about scaling efforts around Giga Texas. Given everything landing this week, that's the next thing to watch. Now, not everyone is convinced, and it's worth carrying the other side honestly. Gary Black, who runs the Future Fund, used the session to lay out a fuller version of his cautious case. And he matters here because he's one of the few credible long-side voices currently sitting on the bear side of this trade. His points are concrete. Tesla is down about 15% on the year, while the Nasdaq is up 16%. The unsupervised robotaxi fleet has been stuck at roughly 40 vehicles. And the stock trades at around 200 times what it's expected to earn next year. Very expensive by any normal measure, at a time when those earnings forecasts are actually coming down. He also pushed back on the popular bull idea that SpaceX, now valued around $2 trillion, will use its own stock to buy Tesla. He estimates that would mean issuing something like 25% more stock to pull off. And he says the governance questions write themselves. The constructive read sits right next to that. Tesla bull Dan Ives still sees a path to $600 a share. On a long list of catalysts that includes exactly the version 14 progress that landed today, and next Tuesday's Giga Texas announcement. And here's the thing worth sitting with. Black and Ives are looking at the very same fleet of around 40 cars and reaching opposite conclusions. Ives is buying that the software progress now visible, a top-tier model running even on old hardware, is the thing that finally breaks the scaling problem open. Black wants to see the fleet number actually move before he believes it. That's the live debate, and the next few weeks start to settle it. On the competitive side, the news today was striking. Volkswagen is ending its self-driving partnership with the supplier Bosch as part of a wider cost-cutting push. And the reason given in the reporting is that Volkswagen concluded the technology simply wasn't competitive, specifically naming Tesla's FSD. Step back, and this fits a remarkable pattern. By the reporting, Volkswagen has now poured something like $20 billion combined into failed autonomy and software bets over the years. Money into a battery firm that went bankrupt, billions into a self-driving venture that was shut down, a fortune into an in-house software unit, and now this. The implication for Tesla isn't subtle. The biggest legacy car maker in Europe has effectively conceded in public that it cannot catch Tesla on the software that everything else in this race depends on. Pair that with Volkswagen also reportedly cutting around 100,000 jobs and closing up to 4 German factories. And Tesla's competitive position in Europe looks materially stronger tonight than it did this morning. There's a related robotaxi data point worth understanding, because it cuts both ways. Waymo and Uber confirmed they've ended their nearly 3-year robotaxi partnership in Phoenix, the very city where Waymo's commercial business began. Waymo has pulled those vehicles back into its own app, and Uber says it's lining up a separate self-driving deal there with a partner it didn't name. For Tesla, this matters in 2 ways. One, it's a clean look at what scale actually looks like in this business right now. Waymo runs in about 11 US cities, with roughly 4,000 vehicles serving over 500,000 rides a week. Against Tesla's roughly 40 unsupervised cars, that's the exact gap the bears keep pointing at. But 2, and more interesting strategically, it sharpens the central question for Tesla. Does Tesla want to own the whole network itself, or be the technology platform that Uber-style demand engines plug into? Waymo just answered that question for itself by walking away from the partnership. It decided it doesn't need anyone else's app anymore. How Tesla answers it shapes how big this can get. A few quicker items to round things out. A Tesla job posting surfaced today for a head of digital advertising, specifically to run paid search, social, and display ads for the energy business. That's a genuine shift, because Tesla's stance for years was that the products sold themselves and it didn't need to advertise. And the choice to start with the energy business is its own signal. Tesla Energy is now big enough with a wide enough set of customers, utilities, data centers, commercial property owners, homeowners, that the company sees paid marketing as worth running. It's a small data point that hints at where Tesla expects its demand to come from next. Over in India, New Delhi is now offering car owners a cash incentive of more than $1,000 to scrap an old vehicle and buy an electric one to fight air pollution. It also exempts cheaper electric cars from road tax and registration fees, which usually run several % of a car's price. Tesla delivered its first Model YL in India earlier this month and is just starting to build out its presence there. This doesn't move the next delivery number, but it points at a real tailwind for the India market over the coming year. And one item from outside Tesla worth a quick flag. The defense drone maker AeroVironment reported after the close and jumped about 15% in late trading. On revenue and earnings that beat expectations, with next year's revenue guide roughly in line. The direct Tesla connection is light, but the move tells you the appetite for defense tech and drone names is still very much alive. And that matters for the broader autonomous and AI hardware basket that Tesla sits inside. Gary Black noted the company has a history of guiding conservatively at the start of its year, so the soft profit outlook may be the usual caution. So what should you be watching over the next week, because it's a loaded one? The single biggest item is Tesla's second quarter delivery and production numbers, due Wednesday or Thursday. That's the most important read before earnings, and it's the number that settles the live argument we just heard between the demand bears and the recovery camp. The real question being whether deliveries actually grow versus a year ago. Thursday morning also brings the June jobs report, which feeds into the interest rate path the Fed is leaning more cautious on right now. And as a stock whose value rests heavily on far-off profits, Tesla tends to feel rate news more than the average company. Friday, the US market is closed for Independence Day, so there's no episode that day. And then the following Tuesday, July 7th, comes that teased Giga Texas announcement. Do those delivery numbers show real year-over-year growth and quiet the demand debate? And does July 7th put an actual launch date on the Cybercab? That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.